You know what's funny? Everyone wants to make money in the markets, but they all want to do it the normal way. They read the same books, follow the same gurus, use the same indicators that millions of other people are using. And then they wonder why they're not getting rich. Let me tell you something I learned over decades of watching markets. People always lose money doing what everyone else is doing. I'm Jim Simons, and today I want to talk to you about why normal thinking doesn't make money, and what you need to understand about trading psychology if you actually want to win. Let me tell you something that took me years to fully understand, and it's perhaps the most important lesson I can share with anyone who wants to succeed in the markets. Normal thinking loses money. It's not just that it underperforms or gives you mediocre returns. It actively transfers your wealth to someone else. The market is essentially a mechanism that takes money from people who think conventionally and hands it to those who think differently. This isn't some philosophical observation. It's the fundamental reality of how markets work. Think about what normal means in the context of investing. Normal means watching CNBC in the morning and making decisions based on what the talking heads are saying. Normal means buying a stock because your brother-in-law mentioned it at Thanksgiving dinner. Normal means selling in a panic when you see red numbers on your screen because everyone else is selling too. Normal means following the crowd, trusting the consensus, and doing what feels safe, because that's what everyone around you is doing. And here's the brutal truth. Every single one of those normal behaviors costs you money. The reason this happens is actually quite logical when you step back and think about it. Markets are competitive environments. For you to make money, someone else has to lose it, or at least miss out on the opportunity you captured. If everyone is doing the same thing, reading the same analysis, following the same strategies, then there's no advantage to be found anywhere. You're all competing for the same small edge, and by the time you see the opportunity, thousands of other people have already seen it too. The opportunity has been priced in, arbitraged away, or completely eliminated. I learned this lesson early in my career, not in finance, but in mathematics. In mathematics, the breakthroughs don't come from doing what everyone else is doing. They come from asking different questions, approaching problems from unusual angles, and being willing to explore territories that others have dismissed or ignored. When I transitioned into running a hedge fund, I applied the same principle. I didn't want traders who thought like other traders. I wanted people who had never been contaminated by conventional market wisdom, people who would look at price movements and see mathematical patterns, rather than stories about why stocks should go up or down. The conventional approach to investing is built on narratives and emotions. People buy stocks in companies they like, in industries they understand, following advice from experts who sound confident on television. They sell when they get scared, when the news turns negative, when their friends start talking about crashes and recession. This feels normal because it's human. We're wired to follow the herd for safety, to trust authority figures, to make decisions based on how we feel rather than what the data shows. But the market doesn't care about your feelings. It doesn't reward you for doing what feels comfortable or what makes sense to your neighbors. What the market actually rewards is seeing what others don't see, or more accurately, acting differently on what everyone sees. When everyone is euphoric and buying, that's when assets become overpriced and dangerous. When everyone is terrified and selling, that's often when the real opportunities emerge. But doing the opposite of what feels normal requires something most people don't have: the ability to separate your emotions from your decisions, to trust a system over your instincts, and to be comfortable being wrong in a way that the crowd approves of. I've watched this play out over and over throughout my career. The investors who make consistent money aren't the ones following conventional wisdom. They're the ones who have trained themselves to think independently, to question assumptions, to look for edges in places others aren't looking. They've accepted that normal thinking is their enemy, not their friend. They understand that if they want extraordinary results, they need to think and act in extraordinary ways. The market is not designed to make normal people rich. It's designed to separate normal people from their money, slowly but surely, through 1,000 small decisions that feel right in the moment, but compound into significant losses over time. One of the most profound realizations I had in my career wasn't about mathematics or algorithms or market structure. It was about human nature. Human psychology is predictable, not perfectly predictable, not down to the exact moment or precise magnitude, but predictable enough that if you can quantify it, If you can remove yourself from the emotional equation, you gain an extraordinary advantage. This understanding became the foundation of everything we did at Renaissance Technologies, and it's something that every investor needs to grasp if they want to survive, let alone thrive, in the markets. Let me explain what I mean by predictable. When markets drop sharply, people get scared. That's not a surprise to anyone. But the interesting part is how that fear manifests in trading behavior. People don't just get a little worried and adjust their positions rationally. They panic in waves. They hold on too long, hoping things will recover. Then they capitulate all at once when they can't take the pain anymore. They sell near the bottom, lock in their losses, and then they're too traumatized to buy back in when prices recover. This pattern repeats over and over. Decade after decade, crash after crash. The names change, the specific circumstances change, but the emotional arc remains remarkably consistent. The same goes for greed. When markets are soaring and everyone around you is making money, you don't want to be left out. It doesn't matter if valuations make no sense, if the fundamentals don't support the prices, if every rational analysis says things are overheated. The fear of missing out, what people now call FOMO, is one of the most powerful forces in financial markets. People convince themselves that this time is different, that the old rules don't apply, that they deserve to participate in the gains everyone else is enjoying. They buy at the top, right before everything collapses. This isn't random behavior. This is human psychology following a script that's been playing out for centuries. What made Renaissance different was that we approached these psychological patterns the same way we approached any other pattern. We collected data, massive amounts of it. We looked for correlations, for recurring sequences, for statistical signatures that emerged when fear dominated or when greed took over. We didn't try to predict exactly when people would panic or what specific event would trigger euphoria. We just recognized that when certain conditions existed, certain behaviors tended to follow, and those behaviors created pricing inefficiencies that could be exploited. The beauty of this approach is that it removes you from the equation. You're not trying to be smarter than the market or braver than other investors. You're simply observing that human beings in aggregate behave in predictable ways under certain conditions, and you're positioning yourself to benefit when those patterns emerge. You're not fighting against human nature. You're acknowledging it exists and using it to your advantage. It's the difference between trying to swim against a current and building a water wheel that harnesses the current's power. Most traders can't do this because they're part of the pattern themselves. When they see prices falling, they feel fear just like everyone else. When they see prices rising, they feel greed just like everyone else. They might intellectually understand that they should be doing the opposite of what their emotions are telling them. But in the moment, with real money on the line, those emotions overwhelm their rational thinking. They become predictable, which means they become the liquidity that more disciplined traders extract profits from. I've always found it fascinating that the same psychological patterns that cause people to fail in markets also make it possible for others to succeed. Fear and greed aren't bugs in the system. They're features. They create volatility, they create mispricing, they create opportunities. But only for those who can observe these patterns objectively rather than experiencing them subjectively. The key is developing systems and frameworks that allow you to see the fear and greed in others without succumbing to it yourself. This is why I hired physicists and mathematicians rather than traditional Wall Street types. These people hadn't been trained to trust their gut or follow their instincts in financial markets. They had been trained to look at data dispassionately, to test hypotheses rigorously, to accept what the numbers showed even when it contradicted their intuition. They could study human psychology as an external phenomenon to be measured and modeled, not as an internal experience to be managed. That detachment, that ability to treat emotional patterns as mathematical inputs, was worth more than decades of traditional trading experience. Here's something that most people don't want to hear, but it's the absolute truth. Your biggest enemy in trading isn't the market. It's not the hedge funds with their sophisticated algorithms. It's not the high-frequency traders or the institutional investors with access to better information. Your biggest enemy is staring back at you in the mirror every morning. It's you. More specifically, it's your need to be right, your fear of being wrong, and your desperate desire to fit in with what everyone else is thinking. Until you recognize this and do something about it, you're going to struggle, no matter how much you study charts or read financial reports. Let me break down why this is such a devastating problem. We all have egos. We all want to be right. When you make a prediction about a stock and it goes the way you thought it would, you feel smart. validated, even superior. That feeling is intoxicating. It's addictive, and it's incredibly dangerous because it makes you start trading to be right rather than trading to make money. These are not the same thing. I've watched brilliant people with PhDs in quantitative fields who could run circles around most professional traders intellectually completely blow up their accounts because they couldn't admit they were wrong about a position. They held losing trades far too long because selling would mean acknowledging their analysis was flawed. They turned what should have been a small manageable loss into a catastrophic one, all because their ego wouldn't let them accept being wrong. Then there's the fear of being wrong, which is almost worse than the need to be right. This fear paralyzes people. They see an opportunity, they've done the analysis, everything points to making a trade, but they hesitate. What if I'm wrong? What if I lose money? What if everyone laughs at me? So they do nothing, or they wait for more confirmation. And by the time they finally convince themselves to act, the opportunity has passed. They've let fear steal their profits. Or even worse, the fear manifests after they've entered a position. The stock drops a little bit well within normal volatility, but they panic and sell for a loss. Then they watch helplessly as it recovers and goes exactly where they thought it would go in the first place. The analysis was right, but the psychology was wrong. The desire to fit in might be the most insidious of all these psychological traps because it feels so reasonable. Nobody wants to be the contrarian who looks foolish. Nobody wants to stand alone holding a position that everyone else thinks is crazy. We're social creatures. We want to belong, to have our views validated by others, to feel like we're part of the group. But in investing, the group is usually wrong at the critical moments. When everyone agrees that stocks can only go up, that's when you should be worried. When everyone is convinced the world is ending, and you'd be insane to buy anything, that's often the best time to be greedy. But having the courage to go against the consensus, to be comfortable being the only person in the room with a different opinion, that takes a level of psychological strength that most people simply don't have. What makes all of this even more challenging is that these psychological issues aren't constant. You might be disciplined and rational for weeks or months, following your system perfectly, keeping your ego in check. Then one big loss happens, or you miss a major move, and suddenly all that discipline evaporates. You start making emotional decisions. You start trying to get your money back quickly through risky trades. You abandon your system because it stopped working, even though it's probably just going through normal variance. You become your own worst enemy without even realizing it's happening. I built Renaissance around the idea of removing human psychology from trading decisions as much as possible. We used computers and algorithms not because they were smarter than humans at analyzing markets, but because they didn't have egos. They didn't care about being right. They didn't fear being wrong. They didn't need social validation. They just executed the strategy, followed the rules, and let the probabilities play out over thousands of trades. When a position lost money, the computer didn't get upset or try to rationalize why it should have worked. It just moved on to the next trade. Most individual investors can't build the kind of systematic infrastructure we had at Renaissance, but they can learn the core lesson. You need to recognize that your psychology is working against you. You need to build rules and systems that protect you from yourself. You need to decide in advance what you'll do when things go wrong, because in the heat of the moment, your emotions will override your logic every single time. The market doesn't care about your feelings, your ego, or your need to fit in. It only cares about whether you can execute a strategy consistently despite all those psychological pressures trying to knock you off course. If you study financial history, and I mean really study it, you'll notice something remarkable. Every major market crash, every bubble that burst, every wealth-destroying event in the last few hundred years follows essentially the same pattern. It's not the specific circumstances that repeat. It's the human behavior. People buy high when everyone else is buying because they don't want to miss out. Then they sell low when everyone else is selling because they're terrified of losing everything. This herd behavior has destroyed more wealth than probably any other single factor in financial markets, and yet people keep falling into the same trap generation after generation. Let's talk about the tulip mania in the 1600s. Tulip bulbs, of all things, became so valuable that single bulbs were trading for more than the annual income of a skilled craftsman. Why? Because everyone was buying them. Your neighbor was making money. Your cousin was making money. People at the market were talking about fortunes being made in tulips, so naturally you didn't want to be left out. You bought in even, though somewhere in the back of your mind you knew it was insane to pay that much for a flower bulb. Then one day the spell broke. Someone decided to sell. then another person. Then everyone panicked and tried to sell at once. The prices collapsed and fortunes vanished overnight. The people who bought at the top because everyone else was buying, they were destroyed. Fast forward to the dot-com bubble at the turn of this century. Companies with no profits, no viable business model, and sometimes barely even a profit were valued at billions of dollars. People were quitting their jobs to day trade internet stocks. Everyone had a story about someone who'd gotten rich. The fear of missing out was overwhelming. Traditional valuation metrics were dismissed as old-fashioned thinking. This time was different, they said. The internet changed everything, they said, and then it all came crashing down. The Nasdaq lost nearly 80% of its value. Life savings were wiped out. Retirement plans were devastated. And once again, it was the people who followed the herd who paid the price. Then we had the housing crisis in 2008. Everyone believed real estate could only go up. Banks were giving mortgages to people who clearly couldn't afford them. People were buying multiple investment properties with no money down. Entire television shows were dedicated to flipping houses for profit. It seemed like the whole country had decided that real estate was a can't-lose investment. Your coworkers were doing it, your relatives were doing it, financial advisors were recommending it, so you did it too. And when the music stopped, when housing prices started falling, the herd stampeded for the exits. People lost their homes, their savings, everything. The pattern repeated once more. What's fascinating to me as someone who spent decades analyzing patterns is how predictable this all is. The specific asset changes, tulips to tech stocks to real estate, but the psychology remains identical. Stage 1 is the early adopters making money on something legitimate. Stage 2 is the word spreading and more people getting involved. Stage 3 is the mania phase, where everyone is buying. Prices become disconnected from any rational valuation, and anyone expressing skepticism is dismissed as not understanding the new paradigm. Stage 4 is the crash, when reality reasserts itself and everyone tries to sell at the same time. And throughout all of this, the vast majority of people are following the herd, doing what feels safe because everyone else is doing it. The cruel irony is that herd behavior feels safe. When you're doing what everyone else is doing, you feel protected. If things go wrong, well, everyone else lost money too, so it's not really your fault. There's comfort in being part of the crowd, but that comfort is an illusion. The herd doesn't protect you from losses. The herd guarantees losses because the herd always buys at the top and sells at the bottom. The herd creates the bubble by pushing prices to unsustainable levels, and the herd creates the crash by panicking simultaneously. At Renaissance, we built our entire approach around not being part of the herd. We didn't care what everyone else was doing. We didn't care what was popular or what was being talked about on financial television. We looked at patterns, at data, at probabilities. When our models said something was overvalued, we didn't care if everyone else was still buying it. When our models said something was undervalued, we didn't care if everyone else was selling it. We were willing to be wrong independently rather than wrong as part of the crowd, and that willingness to separate ourselves from herd behavior, that ability to act based on analysis rather than on what felt comfortable or socially acceptable, that was a huge part of why we succeeded where so many others failed. The herd will always be there, stamping from one bubble to the next crash, and the people who can resist joining it will always have an advantage over those who can't. Let me explain something fundamental about how markets actually work that most people never really grasp. If you're reading the same news as everyone else, reacting to the same headlines, following the same technical indicator, and making decisions based on the same information that millions of other people have access to, you have no edge. Zero, none whatsoever. You're just another participant in a highly competitive game where you bring nothing unique to the table. And in that situation, you're not an investor or a trader. You're basically just donating money to people who do have an edge. Think about what an edge really means. An edge is something that gives you an advantage over other market participants. It's information they don't have, analysis they haven't done, or a perspective they can't see. But here's the problem with modern financial markets. Information travels at the speed of light now. The moment a company releases earnings, millions of people know about it instantly. The moment some economic data comes out, it's been analyzed by thousands of professionals before you've even finished reading the headline. By the time CNBC is talking about some trend or opportunity, it's already been discovered, exploited, and probably exhausted by people who were paying attention weeks or months earlier. I remember back in the 1980s when we were first building Renaissance, we had to be very creative about finding edges. We couldn't compete with the big investment banks on traditional analysis. They had armies of analysts, relationships with company management, access to institutional research that we couldn't match. So we didn't even try. Instead, we looked at the market through a completely different lens. We treated it as a data problem, a pattern recognition problem, a mathematical puzzle. We hired people who had never worked on Wall Street, who didn't know what the conventional wisdom was, who approached price movements as signals to be decoded rather than stories to be understood. That was our edge. Not better information, but a fundamentally different way of processing the same information everyone else had. Most individual investors today don't even realize they're playing a game where they have no edge. They wake up, check their portfolio, read some articles on their favorite financial website, maybe watch a few minutes of market commentary, and then make decisions based on what they've absorbed. But everyone else is doing the exact same thing. You're all reading the same articles, watching the same shows, using the same free charting software with the same indicators. If a stock's RSI is oversold, you can see it, but so can 10 million other people. If a company misses earnings, you know it, but so does everyone else within seconds. Where's your advantage? What do you know or see that others don't? The uncomfortable truth is that having no edge means you're essentially gambling. You might get lucky sometimes. You might buy something that goes up simply because you happen to time it right. But over the long run, over hundreds of trades, if you have no systematic advantage, you're going to lose. You'll lose to the people who have better information, better technology, better analysis, or better discipline. You'll lose to the high-frequency trading firms that can execute trades in microseconds. You'll lose to the quant funds running sophisticated models. You'll lose to the patient value investors who actually understand business fundamentals. You'll even lose to the index funds through fees and poor timing. So what does it mean to actually have an edge? It means doing something differently. Maybe you specialize in a particular sector and develop genuine expertise that others don't have. Maybe you have a psychological advantage where you can stay calm and rational when everyone else is panicking. Maybe you've developed a systematic approach that you've tested rigorously and know works over time. Maybe you have access to information or perspectives that aren't widely distributed. The specific edge doesn't matter as much as having one that's real and sustainable. At Renaissance, our edge came from treating the market as a complex system that could be analyzed mathematically. We didn't try to predict the news or guess what companies would do. We looked for statistical patterns that emerged from the collective behavior of millions of market participants. We found tiny inefficiencies that appeared and disappeared rapidly, and we exploited them with scale and speed. Nobody else was approaching the market quite the way we were, and that difference was everything. The hardest part about this for most people is accepting that if you can't identify your edge, you probably don't have one. It's easier to believe that you're smart enough, that you've read enough, that you understand markets well enough to compete. But being smart isn't an edge when everyone else is smart too. Reading a lot isn't an edge when information is free and instant. Understanding markets isn't an edge when millions of people have studied the same concepts. You need something that actually separates you from the competition, something that gives you a legitimate reason to believe you can consistently extract profits from people who are trying just as hard as you are to do the same thing without that you're just hoping to get lucky. And hope is not a strategy that works in competitive markets over any meaningful time horizon. There's a reason why Renaissance Technologies was able to generate extraordinary returns year after year for decades, while most hedge funds struggled to beat the market. It wasn't because we were smarter than everyone else, although we had brilliant people. It wasn't because we had better information, although we analyzed massive amounts of data. The real secret was that we had systems, rigorous mathematical systems that we tested exhaustively, and then we trusted those systems and stuck to them even when every human instinct was screaming at us to do something different. That discipline, that ability to let the system work, regardless of how we felt in the moment, was worth more than any individual insight or prediction. Let me tell you what happens to most traders who don't have a system or who have one but can't stick to it. They make decisions based on how they feel. The market is up and they feel optimistic, so they buy more. The market is down and they feel scared, so they sell. They see a news headline that worries them, and they abandon their strategy. They have a few losing trades and they start second-guessing everything. They make money for a while and get overconfident, taking bigger risks than they should. Every decision becomes an emotional negotiation with themselves, and emotions are terrible at making trading decisions because they're reactive, short-sighted, and inconsistent. A system, on the other hand, is none of those things. A proper system is built on analysis, backtesting, and probability. It tells you exactly when to enter a trade, exactly when to exit, exactly how much to risk, and exactly what to do when things go wrong. It doesn't care if the news is scary. It doesn't care if you just had 3 losing trades in a row. It doesn't care if your brother-in-law thinks you're crazy for holding a position. The system just executes according to the rules, and over time, if the system is sound, the probabilities work in your favor. The problem is that having a system isn't enough. You also need the psychological strength to trust it and stick to it, especially during the times when it's not working. And here's the thing that most people don't understand until they've lived through it. Every system goes through periods where it underperforms. Every system has drawdowns. Every system will have you questioning whether it's broken. If you've backtested properly, you know the periods are coming, but knowing intellectually and maintaining your discipline emotionally are 2 entirely different things. I've seen countless traders develop perfectly good systems, test them carefully, start using them successfully, and then abandon them at the first sign of trouble. They have a losing week or a losing month, and suddenly they convince themselves the market has changed. Their system doesn't work anymore. They need to try something different. So they abandon the system right before it would have recovered, and they jump to a new approach, only to abandon that one too when it inevitably hits a rough patch. They spend years bouncing from system to system, never staying with any approach long enough to let the probabilities play out. At Renaissance, we understood that our models would sometimes be wrong. We knew there would be periods where we lost money. But we also knew that over thousands of trades over months and years, the mathematical edge we had identified would express itself. Our job wasn't to be right on every trade or even most trades. Our job was to execute the system consistently and let the law of large numbers do its work. When you have genuine edge and you execute consistently, you don't need to win big on any individual trade. You just need to play the game long enough for your slight advantage to compound into significant returns. The beauty of a systematic approach is that it removes the burden of constantly making decisions under pressure. You're not sitting there wondering if you should buy or sell based on how you feel about the current market environment. You've already made the decision in advance by creating the system. Your only job is to follow it. That's incredibly liberating once you accept it. But it's also incredibly difficult for most people because it requires surrendering control and trusting in something other than your instincts. Most individual investors will never build the kind of sophisticated quantitative systems we had at Renaissance, and that's fine, but the principle still applies. You need rules, you need a framework, you need criteria for when you'll buy, when you'll sell, how much you'll risk, what conditions will make you exit a position. Write them down. Test them if you can, and then this is the crucial part, follow them. Don't deviate because the market did something unexpected. Don't override your system because you have a feeling. Don't abandon your approach because it's going through a rough patch. If you're going to succeed in markets over the long term, you need something more reliable than your emotions guiding your decisions, and that something is a system you trust enough to follow even when it's uncomfortable. One of the most valuable traits I've observed in truly successful traders and investors over the years is something that sounds simple but is extraordinarily rare in practice. They're comfortable being uncomfortable. They're okay looking stupid in the short term. They're willing to hold positions that make absolutely no sense to their friends at cocktail parties, that go against everything the financial media is saying, that make them seem contrarian or even foolish. This ability to be psychologically comfortable while being intellectually isolated is worth more than almost any other skill in investing, and most people simply cannot do it. Let me give you a concrete example of what this looks like in practice. Imagine you've done your analysis and concluded that a particular stock is significantly undervalued. All your research points to it being an excellent investment, but the stock has been going down for months. Every analyst on Wall Street has a sell rating on it. The financial press is writing articles about how the company is doomed. Your friends think you're crazy for even considering it. Your spouse is questioning your judgment. Every day you hold this position, you're watching your account balance drop and listening to people tell you that you're wrong. That is deeply uncomfortable. Most people cannot psychologically tolerate that discomfort. They'll eventually cave, sell the position, and then watch helplessly as it recovers and does exactly what their original analysis predicted. The same principle applies in reverse. when everyone else is euphoric about something you think is overvalued. You're at a dinner party and everyone is talking about this amazing investment they're all making money on. They're asking you if you're in on it, and when you say no, they look at you like you're the only person who doesn't get it. They start explaining why you're missing out, why this time is different, why you should really reconsider. The social pressure to conform, to join in, to not be left out is immense. Standing alone and saying no while everyone around you is celebrating their gains takes a level of conviction and comfort with being uncomfortable that most people don't possess. What makes this even harder is that you're often going to be wrong in the near term. Markets can remain irrational longer than you can remain solvent, as the saying goes. You might be right about the fundamentals, but completely wrong about the timing. So not only are you enduring the discomfort of going against the crowd, you're also dealing with the reality that your position is losing money while everyone else's is making money. That combination is psychologically brutal. It tests your conviction, your analysis, and your ability to separate short-term results from long-term strategy. At Renaissance, we had the advantage of being a team of scientists and mathematicians who were accustomed to being wrong publicly. In academia, you propose theories, you publish papers, and you get criticized. You present ideas at conferences and people tear them apart. You develop hypotheses that turn out to be incorrect. Being wrong is just part of the scientific process, and you learn not to take it personally. That background made it easier for us to hold positions that looked foolish to others because we weren't emotionally invested in being right in the eyes of the broader market. We were invested in following what our analysis and our models told us, regardless of how it appeared to outsiders. The financial media makes this challenge even worse because they need to create narratives that make sense of market movements in real time. So if you're holding a position that's going against you, there's always someone on television explaining exactly why you're wrong. They'll find an expert who validates the consensus view. They'll cite statistics that support the popular narrative. They'll interview CEOs who reinforce whatever story the market has settled on. All of this creates an echo chamber that makes your contrarian position seem not just uncomfortable, but objectively incorrect. I've watched people with brilliant analytical minds, people who could see opportunities that others missed, completely fail as investors because they couldn't handle the discomfort of being different. They needed validation. They needed to feel like smart people agreed with them. They needed their positions to work immediately so they could feel confident they'd made the right decision. And when they didn't get that validation, when their positions went against them even temporarily, they lost their nerve and abandoned their strategy. The really successful investors I've known, the ones who made outsized returns over decades, they all had this quality of being able to sit with discomfort. They didn't need the market to immediately validate their decisions. They didn't need their friends to agree with them. They didn't need the financial press to support their thesis. They were willing to look foolish for months or even years if their analysis told them they were right. They understood that if you're only willing to make investments that everyone agrees with and that make you look smart immediately, you're necessarily limiting yourself to average opportunities and average returns. Exceptional returns require being willing to be exceptionally uncomfortable while you wait for your analysis to play out. One of the biggest mistakes I see people make when they approach trading and investing is thinking in terms of certainties rather than probabilities. They want to know if a stock is going to go up or down. They want to know if their analysis is right or wrong. They want to be certain before they make a move. But markets don't work that way. Nothing in markets is certain. Everything is probabilistic, and until you truly internalize that fact and learn to think in terms of probability rather than outcomes, you're going to struggle. No matter how smart you are, or how much analysis you do. Let me explain what I mean by thinking in probabilities. When we developed trading strategies at Renaissance, we never asked whether a particular trade would be profitable. That question doesn't even make sense in a probabilistic framework. Instead, we asked what the probability was of making money on trades that met certain criteria, what the expected value was of those trades over many repetitions, and whether the risk-reward profile made sense given our capital and constraints. A single trade could easily lose money even if the probability was in our favor. That didn't mean the trade was wrong or the analysis failed. It just meant that particular instance fell on the losing side of the probability distribution. Most people can't think this way because they judge every trade by its outcome. If they make money, they think they were right. If they lose money, they think they were wrong, but that's completely backward. You can make a terrible decision and get lucky. You can make an excellent decision and get unlucky. The quality of your decision-making has to be evaluated based on the information you had at the time and the process you followed, not based on whether that particular instance worked out. A poker player who goes all in with pocket aces isn't wrong just because someone hits a lucky straight on the river. Over hundreds of hands, going all in with pocket aces is going to be highly profitable. That's thinking in probabilities. Here's what this looks like in practice. Let's say you've identified a trading strategy that wins 60% of the time. That means you're going to lose 40% of the time. If you execute this strategy and the first 3 trades lose money, you haven't discovered that the strategy doesn't work. You've just experienced normal variance. 3 losses in a row will happen fairly regularly when you're wrong 40% of the time. But most people will panic after those 3 losses. They'll abandon the strategy, convince themselves it was flawed, and move on to something else. They never stick around long enough to let the probabilities express themselves over a meaningful sample size. The flip side is equally important. Being right 60% of the time with proper risk management beats being right 90% of the time with no plan. Let me say that again because it's crucial. That win rate doesn't matter nearly as much as people think it does. What matters is the combination of your win rate, your average win size, your average loss size, and how you manage risk. You can be right 90% of the time and still go broke if your losses are enormous when you're wrong. You can be right only 40% of the time and make a fortune if your wins are significantly larger than your losses and you size your positions appropriately. This is why risk management is so critical and why most amateur traders underestimate its importance. They focus all their energy on finding winning trades, on being right more often, on improving their prediction accuracy. But professional traders focus on what happens when they're wrong. How much will I lose if this trade goes against me? How will I exit? What's my maximum acceptable loss? How much of my capital am I risking? These questions matter more than whether you think the stock will go up or down, because these questions determine your long-term survival and success. At Renaissance, we made thousands of trades. Many of them lost money. We didn't care about any individual trade result. We cared about the aggregate statistics over large numbers. We knew that if we had a systematic edge, even a small one, and we executed consistently, with proper position sizing and risk controls, the mathematics would work in our favor. We didn't need to be certain about anything. We just needed to have slightly better than random odds and let the law of large numbers do its work. The transition from thinking in certainties to thinking in probabilities is psychologically difficult for most people because it requires accepting uncertainty and ambiguity. You have to make decisions knowing you might be wrong. You have to lose money on trades that were still good decisions. You have to win money on trades that were actually poor decisions and not let that fool you into thinking you're smarter than you are. You have to evaluate your process independently from your results, which feels completely counterintuitive to most people. But here's the reality. If you can't think probabilistically, if you need certainty before you act, you're either going to be paralyzed and never make any trades, or you're going to convince yourself of false certainties and make overconfident bets that blow up eventually. The market will never give you certainty. It will only give you probabilities. The successful traders are the ones who accept that, embrace it, and build their entire approach around understanding and exploiting those probabilities rather than trying to predict specific outcomes they can never truly know. I'm going to tell you something that most people in the financial industry won't say, because it's not good for business, but it's the truth and you deserve to hear it. Most people shouldn't be trading at all. They should put their money in low-cost index funds, set up automatic contributions, and forget about it for decades. I know that's not exciting. I know that's not sexy. I know it doesn't make you feel smart or give you something interesting to talk about at parties, but it's the honest advice that would serve the vast majority of people far better than trying to actively trade or pick individual stocks. Here's why this is true. Trading and active investing require a real edge, not just confidence or enthusiasm. You need something that gives you a genuine advantage over the millions of other people trying to do the same thing. Maybe it's proprietary information, although that's usually illegal. Maybe it's a sophisticated analytical framework that you've developed and tested rigorously. Maybe it's access to technology and data that others don't have. Maybe it's genuine expertise in a specific sector that takes years to develop. Maybe it's the psychological discipline to execute a strategy consistently when everyone else is panicking. But you need something real, something substantive, something that would hold up under scrutiny if you had to explain why you expect to beat the market. Most people don't have any of those things. What they have is confidence. They think they're smart enough to figure it out. They think they can read some books, watch some videos, follow some gurus on social media, and somehow gain an edge over professional investors who have spent decades studying markets. It's like watching someone play chess casually for a few months and then deciding they're ready to compete in tournaments against grandmasters. The confidence is there, but the actual skill and edge are not. The data backs this up overwhelmingly. Study after study shows that the vast majority of active traders underperform simple index funds over any meaningful time period. Not by a little bit, but by substantial margins. And that's before you account for the time and stress involved in active trading. When you factor in the hours spent researching, monitoring positions, and making decisions, plus the psychological toll of watching your account balance fluctuate, the opportunity cost becomes even more stark. You're working harder to get worse results than you would have gotten by doing nothing. But people don't want to hear this because it feels like admitting defeat. It feels like saying you're not smart enough or capable enough to succeed at something. And that's not what I'm saying at all. I'm saying that trading is a highly specialized, extremely competitive domain where even most professionals fail to beat the market. It's not about intelligence. Some of the smartest people I've ever met have been terrible traders. It's about having a specific edge in a specific context, and most people simply don't have that edge and never will, no matter how hard they study. The irony is that accepting this reality and investing in index funds is actually the smart move. You're acknowledging that you don't have an edge, so you're not going to waste time and money trying to compete in a game where you're at a structural disadvantage. Instead, you're capturing the market return, which historically has been excellent over long periods at minimal cost with minimal effort. You're essentially saying that you're smart enough to know what you don't know, which is a form of wisdom that many people never achieve. Let me be clear about something. I'm not saying nobody should trade. At Renaissance, we obviously believed active trading could work because we had built systems and infrastructure that gave us legitimate edges. There are individuals who have developed genuine expertise in specific areas and can trade profitably. There are people with the psychological makeup to execute systematic strategies consistently. But these people are rare, and if you're honest with yourself, you can probably assess whether you're genuinely in that category, whether you're just hoping you are. The problem is that the financial industry has every incentive to tell you that you can and should be actively trading. Brokers make money when you trade. Financial media needs you engaged in making decisions, so you keep watching and clicking. Gurus and educators make money selling you courses and systems. Nobody in the industry makes money if you buy an index fund and ignore it for 30 years, even though that's probably the best advice for most people. So you're constantly bombarded with messages that you should be active, that you can beat the market, that you just need to learn this one strategy or follow this particular approach. I built one of the most successful hedge funds in history, so I obviously believe that beating the market is possible, but I also understand how rare it is to have a genuine edge and how difficult it is to execute consistently even when you do. The infrastructure we built at Renaissance, the talent we assembled, the technology we developed, the years of research and testing, all of that was necessary to generate the returns we achieved. And even then, we had periods where things didn't work, where we questioned our models, where the edge seemed to disappear temporarily. If you're reading this and thinking about whether you should be actively trading, ask yourself honestly whether you have a real edge, not whether you're smart or whether you've made some winning trades, but whether you have a systematic, testable, sustainable advantage over other market participants. If you can't articulate what that edge is in specific terms, if you can't explain why it should persist over time, if you can't point to rigorous evidence that it works, then you probably don't have an edge. And if you don't have an edge, the smartest thing you can do is admit that and invest accordingly. The single most important principle that guided everything we did at Renaissance Technologies was this: the market reward objectivity. Not intelligence, not hard work, not experience, although all of those can help. The market rewards the ability to see what's actually happening rather than what you want to happen or what you expect to happen or what makes a compelling story. And the way we achieved that objectivity was by removing human psychology from our trading decisions as much as possible, letting data and patterns guide our actions instead of intuition, narratives, or gut feelings. Let me tell you why this matters so much. Human beings are storytelling creatures. We're wired to create narratives that make sense of the world around us. When we see a stock price moving, we immediately start constructing stories about why it's moving. The company must have good news coming. The CEO must be doing something smart. The industry must be heating up. Or the opposite. There must be problems. Management must be incompetent. The sector must be dying. These stories feel satisfying. They give us a sense of understanding and control. But they're almost always wrong, or at least incomplete, and they cloud our ability to see what's actually there. What we did at Renaissance was strip away all of that narrative overlay. We didn't ask why a stock was moving. We didn't care about the story. We just looked at the price patterns, the volume patterns, the statistical relationships between different securities. We treated it all as data to be analyzed rather than stories to be understood. When our models identified a pattern that had historically been profitable, we traded on it. We didn't need to understand why it worked in any fundamental sense. We just needed to know that it worked consistently across large numbers of observations.